Lucas and Maya are sitting at a kitchen table at 11 p.m. on a Tuesday. There is a pre-approval letter for $480,000 on top of a stack of unopened mail. Maya's coffee has gone cold. Their parents have already texted the word congratulations. Something deep in both their guts is telling them this does not feel like winning. It feels like signing a waiver. So Maya opens a calculator, the one thing nobody in this transaction actually wants her to use. Within 11 minutes she realizes that every smiling person sending them DocuSigns is not on their team. They are on the team of the closing. My name is Root. Today we are walking through the most expensive cultural assumption in America. The assumption that buying a house in 2026 is a smart financial move. Because when you actually run the math, you do not find an investment. You find a beautifully decorated trap. Here is where the market actually stands. The median existing home in America now costs $488,000. That is the 33rd consecutive month of year-over-year price increases, which at this point is less a trend and more a personality disorder. The 30-year fixed mortgage rate is hovering around 6.3%. According to the Atlanta Fed, owning that median home now consumes 47.7% of the median household's income. Nearly half. Not 28%, which was supposed to be the threshold for sustainable. 47.7%. The price-to-income ratio in America has reached 5.0. Historically, from 1975 through the late 1990s, it sat around 3.0. We are now worse than the 2006 peak. 78 of the 100 largest metros are at all-time record ratios. We are at the worst home price-to-income ratio in modern American history. And somehow the collective advice remains, get in before you get priced out. Priced out of what, exactly? Let Root put 5.0 into human terms. If you are earning the median American income of around $80,000 per year, the median house in this country costs you 5 full years of your entire pre-tax salary. Not 5 years of savings. 5 years of everything. Every paycheck, every bonus, every tax refund, rent money, grocery money, the birthday card money. All of it stacked into one house. And that is before a single dollar of interest enters the conversation. Back to Lucas and Maya. They find a $400,000 house, which is what $480,000 of pre-approval actually buys once you account for taxes and insurance. They have $80,000 in savings, putting them in roughly the top 5% of Americans for liquid cash. They put 20% down and finance $320,000 at 6.3% for 30 years. Monthly principal and interest, $1,980. Property taxes, $367. Insurance, $167. HOA, $272. Total before anything breaks, $2,785 per month. Here is what the loan officer skipped in his 6-page PDF. In month 1 of that mortgage, out of the $1,980 Lucas and Maya send to the bank, $1,680 of it is pure interest. Only $299 actually reduces the loan balance. That is 85% of their first payment disappearing into someone else's quarterly earnings. And it stays this lopsided for years. At 6.3% on a 30-year fixed, monthly principal does not exceed interest until roughly year 19. Lucas is 32 right now. He will be 51 before the math tips in his favor. In between, he will have sent the bank approximately $392,000 in interest alone. He borrowed $320,000. He will repay nearly $713,000 total. He bought one house and paid for two. And that is the best case version of the math, the version where nothing else happens. No insurance shocks, no special assessments, no roof replacement, no HVAC failure, no foundation surprises. In real life, the house does not care about Lucas's spreadsheet. It has opinions of its own, and those opinions are expensive. Homeowners insurance in America has risen 46% since 2021, 3 times the rate of inflation. The national average premium now sits around $3,000 per year. That is before you factor in living somewhere the weather has strong feelings about your property. In Florida, the average annual premium is approaching $8,300. Lucas's cousin bought a place in Tampa in 2022. He just opened his renewal notice, $8,300, up from $4,200 3 years earlier. He stared at the number for a full minute before opening his banking app. California is running its own parallel collapse. State Farm stopped writing new policies there in 2023, then non-renewed 30,000 homeowners in 2024. After the LA wildfires generated $20 billion in industry losses, the state approved a 17% emergency rate increase. Insurance now makes up 9% of the typical monthly mortgage payment, the highest share ever recorded in U.S. housing history. Maintenance is running its own inflation economy alongside all of this. The old rule of thumb said budget 1% of home value per year. In 2020, that averaged around $6,200. Today it averages $8,880, a 42% jump in 5 years. Labor is up. Materials are up. And the one contractor who still knows how to service a gas furnace now charges accordingly. A new HVAC system runs $5,000 to $15,000. A new roof easily clears $13,000. Foundation work ranges from $2,000 to $8,000. The most telling survey number from the past 2 years, 42% of homeowners now say maintenance and hidden costs are their single biggest regret about buying. Not the price. Not the rate. The slow, grinding tax of everything that breaks. Then there is the property tax ambush. In Texas and Florida, the moment you close, the county reassesses the property at current market value. The previous owner's tax protections disappear the same day you receive the keys. Your annual bill can double overnight. One analysis found that escrow payments rose 45% between 2019 and 2025. In Colorado, homeowner escrow payments jumped 77%. You did not get a raise. Your house did. And if you purchased a Florida condo, there is specific news worth hearing now rather than later. After the Surfside building collapse, Florida passed laws requiring condo associations to maintain genuine structural reserves. Starting January 2026, associations can no longer waive these requirements. Picture this scenario. You closed on a condo in Aventura in December for $380,000. In February, a certified letter arrives. Your building needs $40 million in structural repairs. Your individual share, $180,000, due within 90 days. You attempt to refinance. The bank declines because your condo is now worth less than you paid, and no comparable units have sold in 6 weeks. You try to sell. No buyer will touch the building. Real Aventura buildings have already hit owners with assessments reaching $400,000 per unit. Florida condo prices are down 9.9% year over year, the steepest drop since 2009. There is a reason. Lucas and Maya are still at the kitchen table. The calculator has been replaced by a second glass of wine. Here is what they are beginning to understand: every major force in this market is working against their future net worth. Prices are at all-time highs relative to income. Rates are historically average and feel punishing only because pandemic-era 3% mortgages briefly distorted expectations. Those rates are not returning. Insurance is compounding. Maintenance is compounding. Property taxes are compounding. And the asset they would be purchasing is, for the first time in a decade, losing to inflation in real terms. Which raises the question the real estate industry absolutely does not want Maya sitting with: what if they simply ran the numbers on renting the same house instead? In all 50 of the largest U.S. metros, carrying a mortgage costs 38% more than renting an equivalent home on average. Bankrate ran the numbers in 2025. The average mortgage payment was $2,768. The average rent for a comparable home was $2,000. The gap widened in 38 of those 50 metros. In San Francisco, owning costs 190% more than renting. San Jose, 186%. Austin, 88%. Los Angeles, 89%. Nearly double in each of those markets. Not a typo. Now take the difference and put it somewhere that compounds.
Lucas and Maya have $80,000 earmarked for a down payment.
Suppose they rent instead, drop that $80,000 into a low-cost SP 500 index fund, and invest the $500 to $800 per month they would save compared to owning at a conservative 7% real annual return, below the historical average and adjusted for inflation. After 10 years, approximately $244,000. After 20 years, $570,000. After 30 years, $1.22 million in today's dollars. That is the actual comparison the housing industry is making when it tells you that buying builds wealth.
Now run the ownership scenario in parallel.
Lucas and Maya pay $400,000. Over 30 years, adding down payment, interest, taxes, insurance, maintenance, HOA, and closing costs, they put in roughly $1.21 million total. If the home appreciates 3% per year above the actual long-run real return on U.S. housing, it grows to approximately $970,000. After paying 9% in commissions and closing costs to sell, they net around $885,000. The house cost them roughly $325,000 net to own, plus the opportunity cost of what the down payment and monthly differential could have compounded into. In most modeled scenarios, the renter who invests the difference ends up wealthier.
Often dramatically so.
Root knows exactly what appears in the comments at this point.
But Root's parents bought a house and tripled their money.
They did. And here is why that tells you less than you might think. Robert Shiller, the economist who won a Nobel Prize specifically for studying long-term housing prices, has data stretching back 130 years. Real U.S. home prices, inflation-adjusted, were essentially flat from 1890 to 1997. Your great-great-grandfather's house was also not a wealth-building asset. He simply lacked a calculator capable of measuring it. Then in the past 25 years, prices went vertical.
Shiller's assessment is that housing was never historically viewed as a wealth-generating vehicle. It depreciates. It requires constant maintenance. It goes out of style. The idea that it reliably builds wealth is a 25-year anomaly that an entire generation mistook for a law of physics. The SP 500 over that same century-plus window has returned approximately 6.5 to 7% per year in real terms. That 6 percentage point gap between equities and housing, compounded over 50 years, produces roughly 10 times the real wealth. Not 10% more. 10 times. That is the difference between retiring at 55 and retiring at 73. So if the math is this lopsided, why is everyone still framing homeownership as the American dream? The answer is not cultural. It is financial.
The National Association of Realtors spent $86.3 million on lobbying in 2024 alone, the single largest organizational lobbying spend in the entire country. They spent another $66 million on marketing and public relations. The word realtor, capital R, is a trademarked brand that costs over $150 million per year to maintain. The American dream you were handed was not an organic cultural inheritance. It was engineered, funded, and distributed by a trade association whose survival depends on you purchasing a home every 7 to 10 years. And now let Root dismantle the most durable real estate slogan quickly.
You are throwing money away on rent.
On Lucas and Maya's $400,000 home at 6.3%, year 1 interest alone is approximately $20,000.
Property tax, $4,400. Insurance, $2,400.
Maintenance conservatively, $4,000.
HOA, $3,300.
That totals more than $34,000 in year 1 that builds zero equity and simply disappears. If they rented a comparable home for $2,000 per month, they would spend $24,000 per year, $10,000 less than owning, while keeping full liquidity and the ability to invest the difference.
If renting is throwing money away, what exactly do you call the $34,000 they handed to interest, taxes, insurance, and fees? A donation with a mortgage attached. And the tax benefit that used to partially balance this equation? Largely gone.
Before 2018, roughly a third of taxpayers itemized and received a meaningful benefit from the mortgage interest deduction. After the tax changes that have since been made permanent, only about 10% of taxpayers itemize. Mortgage interest deduction claims are down 59% in total dollars. 60% of the remaining benefit flows to households earning over $200,000. The NAR's own website quietly acknowledges that for the majority of homeowners, the tax code no longer incentivizes buying over renting. That is the realtors admitting it on their own platform. Here is the uncomfortable part, and Root needs you to stay with this for a moment. If you are 30 years old and cannot currently afford a house, that might be the most fortunate financial circumstance of your decade. The people who can afford them right now, at these prices, these rates, in these insurance markets, are the ones about to discover what a 46% premium increase actually does to a household budget. They are the ones whose HVAC systems will age in sync with their property tax reassessments. They are the ones who will watch their homes lose real value while maintenance bills compound. Not being able to buy is not failure in this market. It might be the first genuine piece of financial luck you have encountered in years. But Root is not leaving without the honest carve-out. There are real scenarios where buying in 2026 still makes rational sense. Rule 1: the price-to-rent ratio in your specific market must be under 15. Not 30, not 40, under 15. That eliminates essentially every major coastal metro and most Sun Belt hotspots. It includes places like Detroit, Cleveland, Pittsburgh, parts of Chicago, New Orleans, and several Midwestern cities where the math genuinely tilts toward ownership. Rule 2: you must be confident you are staying at least 7 years. 10 is safer. With 8 to 10% transaction costs to sell, anything shorter gets consumed by closing friction before appreciation does meaningful work. Rule 3: you put a genuine 20% down without draining your emergency fund or pausing retirement contributions. Rule 4: total all-in housing cost stays under 28% of gross income. Not 40, not 35, 28. That guideline existed because the math behind it is real. Rule 5: the house represents less than 30% of your total net worth at purchase. Above that threshold, you are not diversified. You are concentrated in a single asset you also happen to sleep inside. Hit all 5 of those conditions and buying can still work, not as a wealth building machine, but as a reasonable lifestyle decision with some hedging properties. Morgan Housel describes the primary home as essentially a large liability wearing the costume of a safe asset. Buy it for family stability. Buy it for the neighborhood. Buy it because you want to paint the walls. Do not buy it because a real estate agent told you it is the best investment you will ever make. Across the long sweep of history, it almost certainly is not. Back at the kitchen table at 11:47 p.m. on a Tuesday in 2026, Lucas and Maya have closed the laptop. The pre-approval letter is still sitting on the unopened mail stack. They have not made an official decision yet. But they are looking at the $80,000 in their savings account differently now. It is not a down payment anymore. It is a decision. It is optionality, the ability to move for a better job, to absorb a recession, to avoid being one HVAC failure away from a credit card spiral. That money might eventually become a house. It might become a decade of compounding instead. But right now, it is the most valuable thing either of them owns. And it stays that way only if they do not hand it to a bank in exchange for the privilege of paying $713,000 for a $320,000 loan. If the math does not work in your market, in your situation, on your income, do not buy. That is not a moral failing. It is arithmetic. The trap is not renting. The trap is signing a 30-year commitment to a financial structure designed for an era when houses cost 3 times your income, not 6, and then telling yourself it is the same deal your parents received. It is not. The math has fundamentally changed. Pretending otherwise is how you become someone else's cautionary dinner party story 5 years from now. Rent if the math says rent. Invest the difference aggressively. Buy if and when the math actually says buy, in a market where that conclusion is still mathematically reachable. Run your own numbers. Factor in every cost. And ignore every voice in the transaction whose income depends on your signature.